Hi, Mr. Wonderful here. I
Good evening, good evening, good evening, everybody. How you doing tonight? How everybody doing, man? Welcome, welcome, welcome. Y'all pile on in, file on in. However you gonna come on in, come on in. If this is your first time tuning in to Tim's Tidbits, please allow me to say welcome. If it's not your first time tuning in to Tim's Tidbits, I still want to say welcome. But I want to add a nice hearty thank you for always tuning in to Tim's Tidbits. If you don't know who I am, my name is Timothy Lee Rogers Sr., aka Aranya Grande. That's just Big Spot if you know hablo español. And you're now in tune to another episode of, look over there, the intraday price action recap. And this episode of the intraday price action recap is being brought to you by, y'all know it's being brought to you by the Smart Money Manuscript. Yeah. Well, Tim, what is the Smart Money Manuscript? It's right there on the screen. I might be blocking it. Let me see. Let me get me out of the way. Am I blocking it? Yeah, I'm blocking it. Let me move me out of the way. Right there. Right. It's going to help you unlock wealth. Your step-by-step guide to actionable financial insights. What's actionable financial insights? It's those things that you, when you learn them, you know what I'm saying, not only do you get the insight, you can put it into work. You can put it into effect. You can put it into practice. You can add it to your repertoire, if you will. The gang. If you are a member of the Discord paying through WAP and you have been a member prior to May 27th, 2025, you will have access to it for free. Right? There will be links out there so that you can access for free in the Discord. Right? But there will also be links out there if you want to, bless your boy if you want to buy for somebody else. Everybody else, it'll be $69.99. Why $69.99? I don't know. He said when you put stuff on sale, you can't have a round zero. You got to have like a 99 or a 98 or a 15 or something like that. You can't just have a round. You can't just say $70. You can't say $80. You got to say $79.99. I don't know. Don't ask me. Marketing. All right. What is it going to be? It's going to be everything that I've ever included on this YouTube channel, from beginning to end, from the alpha to the omega. If you want to be a person that controls your own retirement portfolio, if you want to be a passive investor, if you want to be a passive trader, if you want to be an active investor, if you want to be an active trader, if you want to be a day trader, if you want to be a swing trader, it's going to have everything I've ever covered on this YouTube channel in one focused, concise, front to back, cover to cover educational program. All right. So stay tuned. Stay tuned. Coming soon. All right. Now, let's see who up in here so that we can get into the price action recap. Who we got up in here? What's going on, Kim? What's happening, Valentine? Hola, Valentine. I see Joe Toomer up in here. I see Slater up in here. I see a few more numbers than I see names, but them all the names that I see. So that's all the names I'm going to say. Did price do anything today that caught somebody off guard? Did it do something you did not expect? Did it do something you don't quite understand? Did it make you say, things that make you say, things that make you go, If you have any questions, please click on the Zoom link that's pinned to the top of the chat and unmute and say, hey, Tim, I got a question. Say, hey, Tim, I got a question. I expected this and price did that. Right? Feel free to pull up in the Zoom link. Why do I say in the Zoom link? Because the chat is over here. And I look over here. So I can't see the chat. And I can't hear the chat. But if you pull up in the Zoom, you can unmute and say, hey, Tim, I have a question. Again, the link is pinned to the top of the chat. Click on the Zoom link, pull up in the Zoom, because I will not be monitoring the chat because I'm looking this way and the chat is that way. All right. Let's get to it. Here is today's price action on the NQ. This gray rectangular shape that's right here. Let me turn on my fancy dancy. Okay, my fancy dancy has not been activated. Let me go ahead and activate my fancy dancy so I can turn it on. Right here. Right there. That gray rectangular shape that's right there. That's where price opened up for today's trading. It opened up last night at 6 p.m. Eastern Standard Time. For those who don't know, the futures starts trading. The futures day starts at 6 p.m. Eastern Standard Time. And it goes through the following day to 5 p.m. Eastern Standard Time. So for Monday's trading, it starts Sunday night at 6 p.m. and it trades for 23 hours all the way up until 5 p.m. Monday evening. That's the futures trading day. And then Tuesday, it starts 6 p.m. Monday evening and goes until Tuesday, 5 p.m. Then Wednesday's trading go from Tuesday at 6 p.m. to Wednesday at 5 p.m. And y'all get the picture. Y'all get the picture. All right. Y'all get the picture. Okay. So what is that gray rectangular shape? That's the difference between the close on Tuesday's trading day at 5 p.m. and the open on Wednesday's trading day at 5 p.m. and the open of Thursday's trading day at 6 p.m. So the difference between that Wednesday night close and that Thursday's opening price, that Wednesday's closing price and Thursday opening price, that's what's called a new day opening gap. Why is it called a new day opening gap? Because the price, there's a difference in price. So the price closed here for Wednesday's trading at 22,472 and a half. And then it opened up here for Thursday's trading at 22,461 and a quarter. Right? You can look up here, and these you got OHLC, that's open, high, low, and close up here at the top. If I hover over this candle, you will be looking at the close at the C. And when I hover over this candle, you will be looking at the open. Right? So you closed at 22,472 and a half, or 0.50 for Wednesday's trading day. And then for Thursday's trading day, you opened up at 22,461 and a quarter, or 0.25. The difference in between those, because price gapped down, right? This candle closed, and then this candle opened up down here, right? So it's a gap down. Right? So that's why that is what you call a new day opening gap. It gapped down. Okay, in this case. So that's a bearish new day opening gap. Because when this candle closed, right? Just normal price action, the very next candle should just open at the exact same price. But since there's a halt throughout for an hour, right? When price started back up again, it gapped lower. So that's why you got the new day opening gap right there, the difference between the close and the open between two separate days. Okay, that's your new day opening gap, right? That's a quick visual representation of where price started trading at, and it's a PD array. You can use it for all different types of things, but we're not talking about that right now, right? So that's your new day opening gap, right? Quick reference of, okay, this is where price opened up today, right there. It's a bearish new day opening gap. So the open of the day is at the bottom of this. The close of yesterday is at the top of this. Quick reference point. Quick little hip pocket cheat sheet. All right. This black line here at the bottom, that's prior day's low. This right there, that's previous day high. Previous day low, previous day high, right? It's the lowest low that we traded on Wednesday. It's the highest high that we traded on Wednesday, right? This is our Wednesday's entire daily range right there. All right. So we opened up pretty much in the middle of the road, right? If we take us a handy dandy Fibonacci tool, run it from the highest high to the lowest low, right? This dotted red line right there in the middle, that's equilibrium of the entire range, right? Equilibrium. And you see here, we open up pretty much right in the middle of the road, right? If we look right through there, the equilibrium is running pretty much through the consequent encroachment of that new day opening gap. Right? If I stretch this up really, really big here, right? Consequent encroachment is right here where it says bears new day opening gap. That's consequent encroachment right here in this area, right there. And the red dotted line, right? The red dotted line is equilibrium. So we're pretty much right there at consequent encroachment. So we open up pretty much right there in the middle of the road. Closed here, open there, right? Right in the middle of the road of the range, right at fair value, right at fair value. What did price start to do since we opened up right there at fair value? It's kind of hung out there and consolidated for a while. What does price tend to do at 50%? Tends to kind of consolidate, right? Tends to consolidate a lot of time, most of the times, right? So we just kind of hung out there for a while, right? Hung out there for a minute, stayed in that range, right? Traded down a little, traded up a little, right? But we pretty much just hung out in this range, right? Then look at the bodies of the candles, hung out in that range right there, right? Up until about 11 o'clock ish, and then we expanded above that area there, right? Once we traded above that area there, right? Price had chosen a side, right? Price had chosen a side. Okay, because if we look here, right, this was our lowest low on the day, right? Here, this was our highest high on the day there, right? Price was moving bullishly. Overall, we have been moving up, has been in a buy program for a while, very strong buy program for a while, right? So now we have us this bullish dealing range that we're in, right? We traded all the way back down and created relative equal lows. We had bullish SMT here that we looked at. The ES had taken that low. The Dow had taken that low, but the NQ did not take that low. So we had bullish SMT divergence there, right? And then we closed the day up here in the middle of the range, pulled back up to fair value and closed the day out, right? Opened up the next day, right? Right there around fair value. And then we chose a side. We chose the upside right there, right? What do you mean we chose the upside, Tim? Well, price was consolidating here for a while, and then we displaced away, creating a breakaway gap and a fair value gap there. Right, Tim, what's the difference between a breakaway gap and a fair value gap? They're both fair value gaps, but one of them is anticipated to be left open. The breakaway gap, it's either left completely open, traded into slightly, right? But you prefer to see it left completely open, especially when you're breaking out of an area of consolidation, create a fair value gap, and then immediately created another fair value gap. You want to see price use this top fair value gap, which was at 11:15 p.m. as support. You don't want to see price trade back down into the breakaway gap, right? Because you're breaking away. Prices showing you that high momentum and it's not willing to even come back here. That's why it's called the breakaway gap, because it's taken off and it's not willing to even come back there. It has broken away from this area of price action. It's done with it. This is a balanced price range. I'm through with it. I was through with it before you even knew what to do with it. The algorithm is through with it. It's a balanced price range. You don't want to see price coming back down below this area right here. You want to see this order block. See this bullish order block right here, composed of these two down close candles at 10:15 and 10:30 right there. You want to see that bullish order block. If price ever decides to trade back down, you want to see price touch that bullish order block and jump up off it like it's the plague. Why? Because this is the order block whose job is to price. If price ever decides to come back down into this balanced price range. What makes that a balanced price range? Because you've offered buy side and sell side delivery all up and through this range right here, and then you left the area. Now, just offering the buy and sell side delivery does not create a balanced price range. That just says that this area has been efficiently delivered. It's just you can stay here as long as you want. Long as you want to scribble with the marker, you can just scribble, 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 scrabble, scribble, scribble, scribble. It's still not a balanced price range. It's just efficiently delivered. But as soon as you leave that range, now it's a balanced price range. And if you're bullish and you're above a balanced price range, you want to see it be used as support. You want to see it bounce off of it. You want to see it bounce off of it. If you're bullish and you're above it, you want to see it bounce off of it. That's why this order block right here, you want to see it touch this order block. Oh, it's hot. Get up off that order block right there, right? But in the meantime, this breakaway gap, you don't want to see price touch it. And what did price do? It didn't touch it, right? Then we move into midnight. After midnight, that is the true day open. That's the daily open for the algorithm. The algorithm goes from, yes, do you use order flow? Yeah, I use true order flow, Port City Investment. True order flow. I don't use that the book map and the other indicators. We use true order flow around here. Is the market in a buy program or is it in a sell program? That's or is it bullish order flow? Is it bearish order flow? That's the order flow that we use. If you're asking about stuff like book map and all of that, no. But if you're asking about true order flow, yes, we use true order flow. All right. Now, midnight open. This black line right here, that's your midnight opening price right there. Laid out. That's true. That's the true day open. I keep that there so I'll know what was the open of the day for the algorithm. This is the open of the day for futures trading. This is the open of the day for the algorithm. What are the 4 pillars in price? Somebody tell me, what are the 4 pillars in price that's the only thing you need to know to be able to understand price delivery and order flow? What are the 4 pillars? Someone tell it to me. Someone tell it to me.
Open, high, low, close.
Very good. Open, high, low, and close. That's all you need to know. That's all you need to know. If you got the open, high, low, close for anything, open, high, close for the candle, open, high, low, close for the day, open, high, low, close for the session, open, high, low, close for the week, open, high, low, close. All you need is the open, high, low, close for anything. And it can tell you exactly what the algorithm wants to do. Now, you know, Phil, as Michael calls him, he always jumps in there and pushes the button and try to hold the algorithm within a little range. But even inside that range, you can, if you feel like getting in there double dutching, you can trade inside that range using algorithmic signatures. Okay. So after midnight, we consolidate there around the midnight open, right? We're consolidate, and then we leave, right? So we take off, displace away. Fair value gap right there, right? Never came back to it. Breakaway gap, right? Where is this breakaway gap happening at? Where is this consolidation happening at? Let's go and see. 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 Right? So if we take this right here, right? Looking at our range, we already had it, but I'm just going to redo it for y'all, right? This is our daily range for yesterday, right? We are inside this daily range here, right? The key levels where there are going to be high probability PD arrays are found at what levels? Port City Invest, I don't teach people how to trade. So I don't show people my trades. I share my understanding of how to read price action. Now you can use these things to trade, right? But I'm not here to teach anyone how to trade. So I don't share my trades. I don't care if anybody on Al Gore internet think I know how to trade or not. That's not why I'm here. I'm here to share my understanding of how to read price action. You can take what I share with you. You can study it and apply it to yourself, get a good understanding of it, and you can use this to assist you in your personal trading. But I don't teach anyone how to trade, so I don't share my trades. Okay? Okay, thank you. What are these? What do we call the levels? What's going on, Karen?
You find them usually if you're in premium at the discount, maybe or right at 50%, or if we have a deep retracement at that 25% level.
Make it simple. Make it simple. Don't give me all that other stuff. Make it simple. It starts with a Q. It starts with a Q. I'm listening. I'm listening. I'm listening.
Quadrilateral formula. There you go.
Oh my God. Quadrants. Quadrants. Quadrants is found at the quadrants.
Okay, quads. Okay.
The lower quadrant, equilibrium, upper quadrant. That's where the high probability PD arrays are going to rest, right? You can say quarters if you want to call it quarters, but Michael calls them quadrants, right? So you have your lower quadrant, equilibrium, and your upper quadrant, right? If you ever study price and you have a dealing range, that's what I like to call a algorithmic dealing range, you will notice that price will engineer liquidity at these quadrants. And when it engineers liquidity at these quadrants, right, you're either going to get, if you're going up, you're either going to get reaccumulation or offset accumulation at these quadrants, right? If you're going down, you're either going to get redistribution or offset distribution at these quadrants, right? Now, how can you utilize these quadrants? Just say when we start out the day here, we're at equilibrium, right? We want to try to buy in a discount, right? But how can we utilize these quadrants to let us know that it's safe to buy if we're way up here in the premium, like, because this is our dealing range, right? We're way up here in the premium of our bullish dealing range. We've traded all the way back down to a deep, deep discount, right? Start the day out at equilibrium, and then we just kind of continued up, right? But how can we, let's see, right? So this is our dealing range that we're focused on there, our prior days range. This is a algorithmic dealing range, right? Because it's a dispensation in time that the algorithm knows the lowest low and the highest high of that range, right? The lowest low and highest high in a specific time capsule is a dealing range, right? Right? What else makes the dealing range? If you take out sell side and buy side liquidity, right? So when you trade down and take out sell side liquidity, you create a new liquidity pool. You trade up and take out buy side liquidity, you create a new liquidity pool. You have formed a new dealing range that the algorithm remembers. This is the highest high, this is the lowest low, and you can trade inside this range. Okay, so we have our dealing range based off time and price. We came to a deep discount. We want to buy in a discount, right? And now we're opening up at fair value. So when price starts to move, here we are. We're consolidating at equilibrium at the 50%. We're consolidating in the middle of the road. Price takes off and chooses the upside, right? How do you know it's choosing the upside? Because it's displacing a way, right? It's displacing a way. We're bullish. We're in a buy program. So when we displace away to the upside, we know that price is ready to go in that direction, right? If you're in a buy program and you see it trying to displace to the downside, what are we anticipating that to be? Someone, please tell me. What are we anticipating it to be if it starts to displace to the downside and we're in a buy program? What are we anticipating that downward move to be?
Taking out sell side, maybe a Judas swing.
But what are we expecting it to be? It starts with an M.
Oh, well, it's gotta take out the sell side
Yeah, it's taking out the
Take it
sell side.
first. Go ahead. Market
manipulation.
maker. Yeah.
Say it one more time. I heard two people talking.
She said manipulation, right?
Manipulation. Yes. We're anticipating that to be manipulation. And manipulation gives us a better opportunity to participate. Manipulation is going to give us that offset accumulation or offset distribution, right? Because offset accumulation is when we take out opposing liquidity and then move in a direction that we're going. Like here, we consolidate, we take out sell side, and then we move and take out buy side. That's the price engine model of offset accumulation, right? Consolidate, take out sell side, take out buy side. That's the price engine model of offset accumulation, right? So when it chooses the upside, you say, okay, it's ready to go up now, right? But Tim, I didn't get a chance to participate when it was in a discount of my dealing range. No, don't worry about it. Why? Because what do we say about a balanced price range? What do we say we want the algorithm to do if we're above a balanced price range? We said we want to see it use it as support. We want to see it bounce off of it, right? So if we look here inside our dealing range, right, we got all of this back and forth price, right? We leave it, right? We come back down to that same area at that 25%. We got all this back and forth price. We leave it, right? So now guess what? All of this here is a balanced price range. We don't want to see price coming back down, right? So when we get here in the start of our day, we trade down into what? This balanced price range, and we use that support. Bing! Bounce off of it, right? So now price is showing you this is a balanced price range. I don't want to go back down there, right? Come here, trade down, back to our new day opening gap, sitting on top of this balanced price range. Bing! Bounce off of it, right? So while we consolidate here and we expand up here, boom, choosing the upside, when we said about this right here, we want to see that breakaway gap stay open, right? We want to see that breakaway gap stay open. We trade down into the top fair value gap right there. For those who can't see it, let me draw it out for you, right? You got a fair value gap here, right there. Trade down into the fair value gap, work it a little bit, right? Trade up. Here's the midnight open. We open up at midnight, right? We open up at midnight. We trade up, take out buy side right there, right? This is what we call the wig snatcher. Come up, take out buy side right there, drop back down below the opening price, giving an opportunity to enter below midnight, right? Because when we open here at midnight, right, we drop down, well, we trade down there, set a little low there. Then we drop down, take that low out, trade back up, right? Trade back up. That's a Judas swing right there. Boop, boop. That's a Judas swing. In the case of the wig snatcher, what I was talking about starting here is when you go up, go down, and go up, right? Because you trade above the high, come down, trade below that low, and then trade back up, right? So on a lower time frame, you're taking buy side, taking sell side, and going back up, right? But here, after midnight, we drop below that low right there, trade up, Judas swing, come back down, give an opportunity to get long below the opening price, right? Trading back down into that fair value gap that's being used to support price. And then we take off, right? Now, Tim, you still ain't told me how I can trust buying up this high. I just told you. How did I tell you that? Because now that you know that this is a balanced price range, right? Where's this balanced price range? This balanced price range is from 50% down, right? So now you're no longer looking at your dealing range going up from, let's do it like this. You're no longer, once we come up and take out this high right here, right, and extend the dealing range up to that point there, you're no longer anchoring your dealing range to there. You're moving to over here to when we leave that balanced price range right there. Now you're looking at your dealing range from here, from there to there. That's what you're looking at now, right? So as price moves up, comes here, makes a new high, right? You're extending your dealing range to there, right? Trade, makes a new high, right? You're extending your dealing range to there. And then what does price do? It drops down into this is equilibrium, drops down into a discount. Where does it go? To the 25% of our new dealing range, AKA the lower quadrant, right? It comes to the lower quadrant of our latest impulse leg of our entire dealing range. And this is also right around the upper quadrant. Remember the old dealing range, the upper quadrant was like here, right? So we have high probability, lower quadrant, right near high probability, upper quadrant, and we have a fair value gap. We have sell side. Let me get some of this stuff on the chart so y'all can see this. I want y'all to see this. I want y'all to see this, right? We have a whole bunch of stuff here. We got sell side liquidity right here, hanging around that lower quadrant. All right, let me put the old one back on there too. Right, because this was when we first came in, right? I'm gonna make this one, here thicker because this was the first one. All right, so the fat one is from the first one we first started. And then the solid one is for the second one, right? So we have, right? We got that fair value gap, right? Right there at the lower quadrant of the new dealing range, right? Fair value gap hanging right at the lower quadrant of the new dealing range. It was formed right off some consolidation at the old upper quadrant, right? We created a fair value gap and consolidated at the old upper quadrant and then used that as support, right? And then when price started to retrace back down, right? This is the equilibrium of the new expansion leg of the entire dealing range. This is the latest impulse leg of the entire dealing range, right? When we trade back down into the discount, we come down, take out internal sell side liquidity, because whenever we see a manipulation, we want it to go and take out some form of liquidity, right? We want to see that sweep of liquidity on that manipulation, because that's what manipulation is. You're going and manipulating people in and out of the market. You're forcing people in that want to trade a breakout, and you're forcing people out who was in with shallow stops. So you're manipulating somebody. So if it's not taking liquidity, right, don't try to force a turnaround. You want to see that manipulation, right? And so if you're bullish, you want to see that manipulation happen in the discount of your dealing range. So now we're in an extreme premium of yesterday's range. But since the algorithm told you I am done with this portion, right, you're no longer focusing on that. You're just looking for that to support price. And how is it supporting price? But the bottom of the dealing range is now resting on this balanced price range. And so now you're anticipating the algorithm to trade within this area here now, right? So if we hide the original dealing range, right, now you're anticipating price to trade in here. And now your discount is anything below that line. Even though this is our range that we initially started watching, and we're up here in an extreme premium, this is 75%. This is the upper quadrant of the old range, right? Now, that upper quadrant is now your equilibrium. And anything below that is a discount, right? So what do you want to see? Some type of sell side manipulation in the discount of your range, right? There's your sell side manipulation, right? Where did that happen? Oh, let's see, right? We traded down to the open, the algorithmic open, traded down there. Boop. That algorithmic open, where did it go? Traded back up and closed above the 50%, right? It closed above equilibrium. What does that close above 50% tell you? It's strong. It's showing you strength. I'm closing above 50%. I'm manipulating all the way down to the open, and then I'm closing up here above 50%. Open up the next candle. I manipulate out sell side, right? Take out sell side. Trade all the way back down into what? That order block, right? Remember that order block? Trade all the way back down into that order block. What's important about that order block? That's your order block when you left this area. Remember we talked about, we said you want to see the order block price, stop it from going outside of your dealing range. Trade it all the way down to that order block, manipulate it out sell side, and then where did it close? Above 50%, showing strength, right? Above 50% showing strength. So now, if you were not willing to take anything over here because you say we're in a premium, right now you have just got your confirmation that the algorithm does not want to go down. So if you was unable to trust it here, this is now your confirmation. So when you came down and you took out that high right there, right, when you swept that high, now you know the damage has been done, right? The damage has been done below price. So when price drops back down here into what is this right here? That's an order block. Where is that order block? It's resting right there at that quadrant right there. When price drops down into that order block, you can buy it, right? You can buy it. You don't have any fair value gaps in here because price is very efficiently delivered, right? So when it drops into that order block, you can buy it, right? One other thing, you say, you look in here, you say, Tim, I don't have a fair value gap to trade. I don't. Yes, you do. You have a fair value gap to trade. All right.
Particularly within the rate.
Yeah. Mm-hmm. Yeah. Mm-hmm. All right. Mm-hmm.
Let's go.
Yeah. Okay. But go ahead and mute for me. Mm-hmm. Yeah. That's you, Jada.
Oh, sorry.
Mm-hmm. Thank you. Right, but you got a fair value gap to trade. You see this little up in a way right there. That little up in a way right there. Right, price is taking off. Price is doing something here. Right, price was moving. Price was ready to go, right? And then we went into this right here, right? We went into all of this right here. All it's doing right here is engineering liquidity, right? And then we get what? Manipulation, right? And we come back up, okay? Manipulation and come back up. Now, can y'all see it? Did you get it? Did you get it yet? Ooh, my secret. Y'all ain't get it yet? Let me help y'all out. Let me help y'all out. Did you get it yet? Get it. Ooh, my secret. Y'all ain't get it yet? Y'all still don't see that fair value gap yet? Who see the fair value gap? Do y'all see the fair value gap? Do y'all see the fair value gap? Do you see the fair value gap? There you go. You see the fair value gap yet? Y'all still don't see the fair value gap? Who see the fair value gap? You see the fair value gap? Who see the fair value? You see it? What a fair value? Somebody say yes. What a fair value gap at? I see people saying yes. What a fair value? Somebody that's in the disc and somebody that's in the Zoom. What a fair value gap at? Somebody said on the left. On the left, well. Is it on the 4 a.m. candle or the 4:15 candle? This right here is the 4:15 candle. This right here is the 4 a.m. candle. Yes, but I don't know why we would use that one. Right? So come here. We have what do we said that what do we said it is when you got two? What's the one on the bottom? What do we said if you got back to back? What's the one on the bottom? What do we say the one on the bottom is? Breakaway gap.
Breakaway gaps.
Yes. And we say we don't want to, if price is exceedingly bullish, we don't want to see the breakaway gap touched at all. If it's exceedingly bullish, we don't want to see it touched at all. Right? So why did I blot out all of that right there? See all of that right there? Why did I blot that out? Right? What does Michael call that right there? That stuff that I blotted out right there. What does Michael call? My can. I crushed that can that's leaking on my desk. Time distortion. Very good. All right. So that's time distortion. Okay. So now, if we look here, right, blotting out the time distortion, right? Because right now we're like Ant-Man. We can look through what's the names? Where is he? Where is he? Is it in here? Y'all know I ain't gonna be able to go on until I find him. Where's Ant-Man? Oh my God, it's gonna drive me crazy. thought it was in here. Where's Ant-Man? Oh my God. We're gonna do it like this. This is how we're gonna do it. This is how we're gonna do it. There you go. Hey Tim, I'm back, man. I'm back, Tim. I ain't seen you in a minute, my boy. Hey, we're back. We're gonna put Ant-Man over here. See, Ant-Man, see, we see it like this right here. This is what we see. But Ant-Man see it like that. Right? Ant-Man looking, and see when Ant-Man look, that's what Ant-Man see right there. Hey, I see it like this, man. Y'all see all them candles, man. But I know how to look back. I know how to look back like this and see it, man. I can see through the candles. You know, I see through the candles. So when price comes up, takes out the buy side, right? Then what it did, it just dropped back down and took out the sell side right there, right? It just came down, took out the sell side. All of this right here in the middle, what you're looking at, that's time distortion, man. That's time distortion, right? So see right there, that's just time distortion, man. So you letting all that fool you. You letting it fool you. You can't see that there's a Bessie right here. So when we come up, right? We come up there and then we drop down and manipulate out in the discount when we trade back up above that high, right? What is that, man? What model is that? Right? What year model is that? Right? When you take sell side, take out buy side, and then retrace back down into a fair value gap. What model is that? What model is that? Huh? Don't nobody know what model that is? It was all the rage. It was all the rage in London about 3 years ago. That's your clue. About 3 years ago. What model is that? Displace away, right? Take out sell side, take out buy side, retrace back down into a fair value gap, right? Displace away, take out sell side, breaking market structure, retrace back. 2022 model. 2022 model, baby. All day long. But you can't see it because you're not like Ant-Man and you're looking at all that time distortion right there. Right? Looking at all. That's why y'all hear Michael say all the time, we cut through candles. Right? We cut through candles. Why do you cut through candles? Right? Because of things like time distortion. Right? All this time distortion, it's doing nothing. The algorithm remembers that there's a PD array resting right here, right at the upper quadrant of the dealing range. Right? It's resting right there at the upper quadrant of the dealing range. Where are your high probability PD arrays? Right? At these quadrants, the upper quadrant, equilibrium, lower quadrant. Those are where your high probability PD arrays rest. Right? So when price traded down and manipulated out the sell side in the discount of the move, we traded away, breaking market structure here. See, came back up, traded above the high, and then we retraced back down into that fair value gap right there. Right? You say, Tim, we overshot it. I know we overshot it because we overshot it and came down into that order block right there. Right? Notice we did not touch the breakaway gap. We came down into that order block right there, right? Closed, highly respecting the fair value gap. But if you came in with your fair value gap entry right there, right? Boom, enter in on your fair value gap. You got a breakaway gap down here. You got to at least account for that, right? With your stop, you're going to at least account for the breakaway gap, right? Stop management is up to you. You want to go below consequent encroachment of the breakaway gap, below the low of the candle, below the swing. However your stop management is, that's up to you. But there's the fair value gap right there that you would be focusing on in the case of this set up right here, right? And then what else do you have in there as far as confluence, right? What else do you have in there as far as confluence to help you out, right? You have other stuff in there, like you have a bullish breaker with an inversion fair value gap inside the price leg right there, right? That's confluence there to let you know this is a safe area to trade, because whenever you got a bullish breaker with a inversion fair value gap in the breaker leg, you anticipate price to come down to that inversion fair value gap. And look at the bodies of the candles. Where are they respecting? This body closed inside the the inversion fair value gap, traded down, closed inside the inversion fair value gap. This candle right here traded down. What did it trade down for? It's manipulating out sell side right there. It's trading into the fair value gap. It's trading into the bullish breaker, and then it's out of there. 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 Hey, Ant Man, appreciate you, man. And that's how you can learn to trust buying when you're up here. This is what, when y'all hear me say price has to show me, it has to show me that it doesn't want to come back down anymore. When I be like, hey, we're in extreme premium, I need for price to show me that it doesn't want to go back down. I need for price to show me that it wants to continue higher. And this is what I do to let price show me that, right? This is what I do. Hey, man, that's all I got, man. And I hope y'all found this helpful, man. Hope y'all got something out of this. I'm saying, remember, this episode of Price Action, Intraday Price Action Recap, being brought to you by the Smart Money Manuscript. It's going to be covering everything I ever shared on this YouTube channel. If you want to be a passive investor, a passive trader, an active investor, an active trader, a day trader, a swing trader, trade options, trade futures, trade, swing trade, day trade, stocks, anything you want to trade, anything you want to invest, you know what I'm saying? Whatever you want to do, I'm going to be sharing everything I've ever talked about on this YouTube channel in the Smart Money Manuscript. That's all I got, man. Who got something for me? Anybody got anything for me? Anybody got anything for me? Any questions? Anything they want to share? Anything for me? Slater, what you texting me, cuz? I see a text from a long time ago. What you talking about, cuz? What you sending me a screenshot for? What you talking about?
Oh, you can hear me?
Yeah, I hear you. What's up?
Man, Mike trying to tell me that you can't get on there and trade. I say, man, you can trade. He trying to tell me, he telling me the wrong information, cuz I can't listen to him. That's basically all I'm saying. I sent that to him.
Man, y'all crazy, man.
He talking about you got to look at the 1 hour counter, the 30-minute counter, the 15, 5-minute counter. You got to look at all the counter and check down this, that, and third. I say, man, no, you don't, man. I say, all you got to do is you just got to know where to get in and where to get out. The open, the close, the high and low. That's what I was trying to tell him, but I wasn't saying it right. I said, once you know that, man, you can go ahead and start trading. He like, yeah. Why you ain't trading yet? Cuz
you gonna lose a lot of money, cuz.
Hey, I ain't jumping now. I'm just saying, I ain't jumping now.
you probably lose a lot of money.
All I'm saying is, don't be trying to tell me like you know what's going on. Hey, let me get out here and get in the field and get some practice in. That's all I'm saying.
Okay, practice in a sim account, cuz.
Hey, man, I ain't doing that. I'm just trying to tell, man, it's gonna take you about 2-3 years.
Practice in a sim account, cuz. Practice in a sim account.
Hey, if I feel comfortable jumping in there, just let me go ahead and jump in there, man.
Go ahead and jump, cuz. Keep a
That's
bungee
all.
cord on. Keep a bungee cord on. Thoughts on 15-second charts? Price fractal. Price fractal. So 15-second, it don't matter. I look at 15-second charts too. I look at all time frames. Price is fractal.
No,
the algorithm gonna be the algorithm. No, somebody asked that in the chat.
Oh, I'm sorry.
Yeah, our price is fractal. So all time frames, the same thing. We've dropped all the way down to 15-second charts and showed how the algorithm is still being the algorithm on 15-second charts. Now, let me add this caveat in. It don't matter if you drop down to a 1 minute, 5 minute, 15-second, 5-second, 1 second. When you drop to the lower time frames, you have to be bringing the narrative from the higher time frame, which you can't go down and try to build your narrative on the lower time frame. You're dropping to the lower time frame looking for an entry, right? You get your narrative from up here, right? That's where the narrative comes from, up here. And then you drop down to the lower time frame looking for an entry. Why are you looking for an entry on the lower time frame? Because that's going to help you be able to possibly formulate an entry that's going to give you a better risk to reward, right? Because when you drop to the lower time frame and you have, I can show you better than I can tell you. I can show you better than I can tell you. I'm a visual learner, so I like to give it to people visually. Before I go through all this right here, Steve Henley, are you still in here? I don't want to do all this talking, and Steve, you ain't in here no more. Steve, are you? If you still here, Steve, say yes, or put a 1 in the chat. Yep. Okay. All right. So we're going to come here and we are going to frame out this fair value gap entry. Right. So we're going to frame out this fair value gap entry. This is 10:45 and this is 11:30 right here. All right. So we're going to frame out. No, better yet, let's do this right here. All right. We're going to come here. Right there. Okay. Because so this right here, I already know I'm gonna be able to show exactly what I'm talking about using the order block, right? So looking at the order block, okay. Somebody, gang, I'm gonna put y'all on the spot. Gang getting thin over there. They running now. You know, we have mandatory stops and safe stops when it comes, like all PD arrays got mandatory stops and safe stops, right? So if we are entering in on this order block right at the opening price of the order block, right? Where can we put our stops? Where is the absolute minimum that you can put a stop if you are entering in on the order block, right? The absolute minimum. Well, we'll start like this right here. Where's the mandatory stop? Where's the mandatory stop if you entering in on the order block right here? Where's the mandatory stop? Hello? It's me. Gang. Don't y'all get quiet on me now. Uh-oh. My feelings getting hurt. Below the order block. I appreciate you. I appreciate you, Steve. Right? So your mandatory stop is going to be here. Right? That's the absolute, that's your mandatory stop. right? Below the close is going to be your mandatory stop, right? Your absolute minimum, right, would be below mean threshold, below the halfway point. That's the absolute minimum. And then your safe stop is going to be below the low, right? It's going to be below, actually the safe stop is below the swing low that the order block is in, right? That's your safe, this is your safe stop right here, right? That's your safe stop. That's your mandatory stop. And this is the absolute minimum that you know what I'm saying? Because you don't want to see price going below. It can wick below mean threshold, but you really don't want to see it hitting mean threshold. Okay. So now we got these lined out for our, if we entering in based off this 15-minute order block, we got our absolute minimum, we got our mandatory, and we got our safe. Okay. On the 15-minute time frame. The narrative is on this 15-minute time frame, this is where we're entering to go long. Now, as price is trading down here, coming down to the order block, as it's coming to the order block, we drop to a 15-second chart as we're trading down here, right? So let's go down to a 15-second chart, right? Boom, 15-second chart, right? So now on our 15-second chart, here we go, okay? On our 15-second chart, right, we come in here and we see on our 15-second chart there that you can do it one of two ways, right? The first way you can do it, right, is you can do it based off of, right, a PD array that aligns with your entry point. This is our entry point right here on the 15-minute, right? And you can do it with a PD array that aligns with your entry point. So what PD array do you have here, right? We have a fair value gap here, right? We got a bullish order block here, right? So, right, and in this case of the fair value gap in the bullish order block, right, and in this case of the fair value gap in the bullish order block here, right, the fair value gap entry, right, your mandatory stop will be below the body of the fair value gap candle, and the safe stop would be below the swing low, right, of the fair value gap. The order block entry, right, below the body, below the swing low, right? And then the absolute minimum would be mean threshold, but we're not even going to worry about that right now. Below the body, below. So we're just going to say both of these, the fair value gap or the order block, right? Either one of these that you take, we're going to say we're using the safe stop. We're going to the absolute safe stop in this case right here, right? So with that being said, right, we're entering here, right? And our stop is going just below the low. Put it a couple ticks below the low, right? Slide to the, all right. Here we go. Boop, right? So there, based off the 15-minute chart, this is our entry based off of the 15-minute time frame. We're utilizing 15-second PD arrays that's in confluence with that, right? This is our entry off the 15-second time frame, right? And we're doing it based off of order flow, what order flow has given us, right? Why? Because we came up here, breaking market structure there, traded back down, right? Kept going up. So now we don't want to see this low taken out, right? That low, we don't want to see that low taken out right there based off the 15-second time frame there. Don't want to see that low taken out. So we entering off this right here, we're putting our stop there, right? Off the 15-second time frame. Now, Remember, off the 15-minute time frame, right? We're gonna just stretch this up. We're just gonna stretch this up to right there. Off the 15-minute time frame, right? This was our entry right here at that line, right? And our absolute minimum was there, right? Then our mandatory was there, and our safe stop, if I can get it lined up, was there. All right. And then we don't even have our targets, but you can just looking at it like our targets is up there, but just looking at it, you can see it's far better risk to reward using the 15-second entry, but we're doing it based off the higher time frame. And then so the second way, I said there's two ways you can do it, right? The second way you can do it is utilize, this is the first way, right? That's the first way to do it there. And then the second way you can do it is to utilize the 15-second, right? Once we come down into our entry, right? When we trade back up, right? We trade back up here. We trade up. And then once we trade back up, we create an inversion fair value gap right here on this counter there, right? We create an inversion fair value gap here, right? And then we could use that inversion fair value gap right there, right? That's our safe stop there, right? That's our safe stop there. And we go up from there, right? Now, it's two different ways you can use it, right? So it's two different ways you can use it. So in the case, the second way, right? The first way gave you a better risk to reward, right? And the second way gave you a better risk to reward than using the higher time frame overall, right? So both ways you got a better risk to reward using the 15-second, but the first way of using the 15-second PD array that align, in this case, is not going to be all cases, but in this case, the first way using the 15-second PD array that's aligned with your entry as you come down, right, gave the best risk to reward. But entering in on a confirmation, right, entering in on a confirmation on the 15-second still gave you a better risk to reward than the what's the name? So, like I say, you want to look for the entry as you come down, right? Once our trade is invalidated on the 15-second, then more than likely it's going to fail on the higher time frame. No, you may be getting in too early, or your stop loss may be too tight. You may be getting, because your trade is not invalidated. Your trade is not invalidated on the 15-second. It's invalidated on the higher time frame. The trade isn't your invalidation point is here. This is your invalidation point down here. Because if you go to the 15-minute time frame, right? If you go to the 15-minute time frame, all your narrative come from your higher time frame. So in the case of this right here, right, the damage has been done. See, your damage has been done here. This is your stop rate. This is your manipulation. This is your smart money getting long below the opening price, the smart money getting long below sell side liquidity. So the damage is done down here. This is the manipulation. So this is your invalidation point for your long, right? So this is where your trade is invalidated at. If you get stopped out on a 15-second up here anywhere, your trade is still not invalidated, right? It's not invalidated until you invalidate it on your higher time frame. You just may be choosing a bad entry on the 15-second because you're trying to force a narrative on the 15-second instead of just looking for an entry. right? You get your narrative from, because like I said, your entry, right? Your narrative is, I want to enter at this price, right? You're not looking, we're not looking for drawings. We ain't looking for magical fair value gaps drawn out. We're not looking for magical horizontal rays. There's no magic in these drawings that we put on there, right? We're putting these drawings on there so that we can visually see what the algorithm is going to refer to, right? We want to visually see the opening price of this 9:30 a.m. candle. Why do we want to visually see that? Because the algorithm is, we're anticipating the algorithm to use this as a bullish order block. Why are we anticipating the algorithm to use that as a bullish order block? Because we consolidated here, engineered liquidity, the algorithm manipulated short sellers into the market, manipulated long buyers out of the market, and then displaced away, taking out buy side, showing that it's ready to go up. Now that it has done that, now we know it's going to use this as an order block to block price from coming back down to this low right here. That's why we want to know what's the opening price of that 9:30 candle, because that's what the algorithm is going to refer back to, right? So I want to get long at that 9:30 opening price, which is 22,552 and a quarter. I want to get long there. That's why I want to get long at. So when I drop down to my 15-second chart, right, I know I want to get long at 22, no matter if I have nothing drawn on my chart. All right. If I come over here and I have nothing drawn on my chart, get out of here. Right. I need one of those lines right there. Right. So I can see the number, right? So if I ain't got nothing else drawn, I don't see any fair value gaps. I don't see anything. I just know I want to get long at that 22,552 and a quarter, because that's the 9:30 order block that the algorithm is going to use to block price from going down. All right. So if my stop, if I don't have a whole lot of money, right, and I say I want to get long here, just say I'm trading, and I shouldn't be trading the minis, and I'm trading the minis, and right, if I come here, let me see here, right there, it says, and this all I can afford. This is the only stop loss I can afford right there. Right, that's the only stop loss I can afford, but I want to trade the minis and I want to get long because that's it right there. Boom, I just got stopped out. I just got stopped out because that's all I can afford to put on. But it doesn't invalidate the trade. Right, I just got stopped out. Right, I just got stopped out. Even I'll do you one better. Right, we come over here. I know I want to get long on at that price. Right, I want to get long at that price. Right, let's go back to 15 minutes. Right. Right, I want to get long at that price. Okay. So let's go. Well, we don't touch it there. Let's go back right here. Let's use the wick. We're gonna cause we want to see the sensitivity in the wick. Remember, we say we want to see the sensitivity in the wick of the order block, right? So you say, I want to get long inside the wick of the order block. Okay. I want to get long inside the wick of the order block. So we touched it on that candle right there. Right. So we getting long right here. This is when we got long. And let's just say we could only afford to put our stop to below consequent encroachment of the wick. Right. That's all we can afford to put our stop to. Right. Right there. Right. That's all we can afford to put our stop to right there. Roughly 10 points. Right. Right there. Right. That's going to get us right there. What's the low on that candle there? 22,556.50, and our low is 22,556.50. That's going to get us. That's gonna get us right there. It don't got to push through when you got a stop limit in. That's all you can afford to risk. Those 10 points, right? So when price comes down, right, and picks us up, it picks us up right here. Now we're gonna go down to the 15-second chart. All right, we're going down to the 15-second chart right here. So we get picked up. This one we get picked up right here. This when we get picked up on this candle right there. We get picked up right there. All right. So we come down, right? Price comes down, picks us up. This all the far we can afford to put it, right? We trade back up. We know we want to get long at that price. Why? Because that's our order block, right? The wick of the order block, right? So we trade up, right? We come down, get picked up. We trade up, we come down, we get stopped out. Boom. We get stopped out, right? Price trades away, gone, and price comes back down again, back to that same area, right? Now, we're afraid to even touch it now. Why? Because we got stopped out right over here, right? We're afraid to touch it because we got stopped out. Why did we get stopped out? We got stopped out because we got in with a very tight stop loss, and we got in prematurely with a very tight stop loss. But the trade is not invalidated because we got stopped out. What invalidates the trade, right? If we trade below this low right here, right? Why does that invalidate the trade? Because on the 15-minute time frame, right? On the 15-minute time frame, price has come down, manipulated out the lows, displaced back up, taken out the high. That gives us a bullish Judas swing. Boom, boom. So now price should not trade back down below that low. It should respect that order block right there. If we trade below that low, that invalidates the trade. Make sense? Make sense? Steve, you still here or you gone? All right. Do anybody got anything else? Anybody got anything else? All right. I don't hear nothing. I don't see nothing. Don't hear nothing. Don't see nothing. That's it. All right, y'all. Tomorrow is Friday. Diamond members, we got tape reading in the morning at 9 a.m. Diamond members, we got tape reading in the morning at 9 a.m. So I'll see y'all in the morning at 9 a.m. Everybody else, y'all enjoy y'all evening. Remember, if you're going to trade, please trade safe. If you're not going to trade, please take copious amounts of notes so you can study what you saw in price and then apply it to your future trading endeavors. Till the next time I decide to get on Algo's internet and share my thoughts on this thing they call price action. It's your boy, Timothy Lee Rogers Sr., aka Aranya Grande. That just means big spot if you don't hablo español. Y'all be safe out here in these trading streets, man. Gone.